I recently sold my Cameco shares, and in this video, I will explain you why. First, we'll look at some financial metrics, then we will dive into Cameco's reserves, and in the end, I will share with you two stocks that I believe may be better investments than Cameco. Now, before we begin, just reminding you that nothing in this video or on this channel is investment advice. Anyway, Cameco is one of the most well-known names in the uranium investing world, being the largest miner in the sector by market cap. It is a Canadian company that operates some of the richest uranium mines out there, like Cigar Lake and McArthur River, focused primarily in Saskatchewan, a region that is often considered the Middle East of uranium. Its shares trade on the New York Stock Exchange under the ticker CCJ, and from my entry point in 2022 to my exit point just below its current all-time high, I managed to achieve a total return of about 164%. However, I decided to close my position because, in my opinion, this stock is simply too expensive. And why do I say that? Because, think about it. Cameco's current market cap stands at around 22 billion. However, if we look at the company's revenue, we'll see that over the past 12 months, Cameco generated around 2 billion in total revenue. This means that Cameco is trading at more than 10 times its revenue. Now, I don't know about you, but that's the kind of multiple I would expect from a tech company with high growth, high margins, and recurring revenue, which is far from being Cameco's case. Cameco, for instance, relies heavily on uranium prices to keep growing, meaning that it depends on an external factor, which for me is a huge disadvantage. Moreover, even with uranium prices hitting record highs recently, as we see here, Cameco has a gross margin of only about 32%. That's a decent margin, but it's far from exceptional, and certainly doesn't justify such high multiples. Now, of course that if uranium prices skyrocket in the long term, and Cameco manages to lock in most of its contracts at extreme prices, then sure, we could see a much higher gross margin. But in that case, we would be relying on a very optimistic scenario, which I usually don't like to do. Now, for those who don't like evaluating a company based on its revenue, let's take a look now at Cameco's profit. Over the past 12 months, Cameco delivered a profit of $86 million, as we see here. Now, sure, it's always good to see a profitable company, but the reality is that Cameco is trading at an incredible multiple of 270 times its earnings. Even if Cameco increases its profits by 4 times, this company would still be trading at around 70 times earnings, okay? Now, if we look at Cameco's operating cash flow, the picture improves a bit. Over the past 12 months, Cameco delivered about $430 million in operating cash flow. However, even so, this means that Cameco is trading at around 50 times operating cash flow, which is still a very high multiple in my opinion. Okay, the company's results could improve, and Cameco could start generating more cash, which would certainly lower this multiple. However, still, I can find many good businesses out there which don't rely on external factors like commodity prices, with much higher margins and recurrent revenue, trading at 10 times operating cash flow or less. So my point is, why should I pay 30, 40, 50 times operating cash flow on Cameco? So that's the first reason why I decided to close my position in Cameco, because I think the stock is trading at very high multiples. Yes, I still believe that uranium prices will go up in the long run, but even so, everything has a price, right? Just because I think uranium prices will go up doesn't mean I need to pay absurd multiples for a mining company that, if you really think about it, isn't that great of a business. Okay, so now it's time to talk about Cameco's reserves. But before we do, if you want to stay updated on the investment thesis I'm following, if you want to dive deeper into them, I suggest you sign up on my website, Capital Edge Research. It's completely for free. My content usually gets released there first and only later here on YouTube. But for example, my article about Cameco was out 1 week, 2 weeks ago. Anyway, let's talk about Cameco's reserves now. As you can see here, Cameco has 485 million pounds of uranium in proven and probable reserves. So let's say that in the future, uranium prices reach $200, okay? Now, let's keep in mind that today, uranium is being priced at $70. But anyway, let's be really optimistic here, right? So 500 million pounds times 200 equals 100 billion. So Cameco's proven and probable reserves could be worth $100 billion, right? However, you still have the extraction costs, right? So let's say that Cameco manages to keep 40% of all the cash generated by these reserves, which is an extremely optimistic assumption. After all, 40% is a lot. So in this case, we would be talking about a $40 billion total value. So from 22 billion, which is the current market cap, to 40 billion, well, it wouldn't even be a 100% increase. And then you might say, but you've only considered a part of the reserves. You still have the measured and indicated reserves and the inferred ones, which is true. So now let's consider the total reserves, including the inferred ones. So in total, we are looking at around 1 billion pounds of uranium, which is massive. Now 1 billion pounds times $200 equals $200 billion. Assuming they can achieve a 40% cash margin on this operation, that would translate to around $80 billion. So in other words, from 22 billion to 80 billion, this means that Cameco would be a 4x, but that's with super optimistic assumptions and maybe unlikely ones. So even though I believe uranium prices will go up in the long run, I still think Cameco is expensive. It seems like in order to make money here, I would need to rely on a very favorable scenario. And for those who follow me, well, you know I prefer to invest in stocks that are priced based on more realistic or more pessimistic assumptions, because that way, even if the company delivers below average results, I can still make money. So in summary, that's why I decided to sell my shares, because I think Cameco is quite expensive, while there are plenty of excellent opportunities out there trading at much lower multiples. For example, Riskified, about which I've talked in this video here. Riskified is a cybersecurity company that provides solutions for online fraud. Its business is getting increasingly better, it has good margins, and doesn't depend on an external factor such as a commodity price. And by the way, I also wrote a very detailed article about Riskified, which I've posted on my website. Or if you're looking for a commodity stock, I would much rather prefer a copper play called Oracle Resources, about which we've talked in this video here. But Oracle Resources is currently being priced at around $50 million, while its copper reserves have been estimated at $2 billion. So there's a much greater asymmetry here between value and price when compared to Cameco. I know that nuclear energy and uranium are hot topics today, but even so, I think Cameco is quite expensive. Anyway, that's it for today. Again, nothing in this video was investment advice, okay? And well, see you next time.